When oil prices surge, the headlines usually blame conflict, instability, or sudden supply disruptions. The story is framed as chaos in the world's most important commodity market. But chaos rarely explains everything, because every spike in oil prices sends billions of dollars flowing through the global economy. And those flows don't disappear. They move from one set of hands to another. Some countries struggle under higher fuel costs. Some industries face shrinking margins. Households feel the pressure at the pump. Yet somewhere else, someone is profiting. So when oil prices surge, who actually benefits? To understand that question, we have to step back from the daily headlines and look at how the global oil system really works. Oil is not just a commodity, it is the backbone of modern economic activity. It fuels transportation, manufacturing, agriculture, and global shipping. Nearly every product in the modern economy depends on energy somewhere along its supply chain. Because of that, the price of oil influences far more than gasoline. It affects inflation, the rate at which prices rise across the entire economy. It shapes government budgets. It influences currency stability and financial markets. When oil prices move sharply, the consequences ripple through the entire global system. History offers many examples. During the 1973 oil crisis, when Arab producers restricted supply in response to geopolitical tensions, global oil prices quadrupled. Western economies experienced inflation, recession, and long gasoline lines. But oil-exporting countries suddenly gained enormous financial power. Petrodollars, oil revenues earned in US dollars, began flowing into global banks and investment markets. That shift reshaped international finance for decades. A similar pattern appeared during the oil price surge of the 2000s. Amidst rapid economic growth in China and other emerging economies pushed global demand higher. Oil climbed above $100 per barrel. Energy companies recorded record profits. Oil-exporting nations accumulated massive financial reserves. Meanwhile, energy-importing economies faced rising inflation and growing trade deficits. This pattern reveals something important. Oil price spikes redistribute wealth. They move financial resources from energy-consuming economies toward energy-producing ones. Countries that export large volumes of oil often see their government revenues surge when prices rise. Saudi Arabia, Russia, the United Arab Emirates, and other major producers earn billions more from the same physical volume of oil when the price increases. That revenue strengthens national budgets. It allows governments to fund infrastructure, social programs, sovereign wealth funds, and sometimes military spending. Sovereign wealth funds are government-owned investment funds that manage national savings, often generated from resource exports. When oil prices rise, these funds can expand rapidly. And those investments flow into global financial markets, real estate, technology companies, and infrastructure projects around the world. But producers are only one part of the equation. Oil companies themselves also benefit when prices surge. The world's largest energy companies, such as ExxonMobil, Chevron, BP, and Saudi Aramco, generate higher revenue from each barrel they produce. When operating costs remain relatively stable, higher prices translate directly into higher profit margins. These profits often flow back to shareholders through dividends and stock buybacks. Investors, pension funds, and institutional asset managers all become indirect beneficiaries of rising energy prices. But the profits don't stop there. Another group quietly benefits during oil price spikes. Commodity traders. Companies like Vitol, Trafigura, and Glencore specialize in buying, storing, transporting, and selling physical commodities around the world. When markets become volatile, traders can profit from price differences between regions, timing advantages, and logistical expertise. In periods of sharp price swings, trading houses have historically generated billions in earnings. Yet the story becomes even more complex when we look at geopolitics, because many oil price surges are triggered not by supply shortages alone, but by risk. This is known as a risk premium. A risk premium is the extra price traders add to oil when geopolitical tensions threaten supply. If markets believe that conflict, sanctions, or instability could disrupt production or shipping routes, prices often rise even before any actual disruption occurs. Sanctions are economic restrictions imposed by governments to limit trade with a country, usually to pressure political behavior. They can restrict oil exports, block financial transactions, or limit access to technology. When sanctions target a major producer, global supply tightens, and tighter supply typically pushes prices higher. But even countries under sanctions sometimes find ways to sell oil through alternative buyers or discounted routes. That means the global supply doesn't always disappear, it simply shifts. Meanwhile, the higher global price can still boost revenues for other producers who face no restrictions. Geopolitical tensions can also threaten critical goods. Oil moves across oceans through narrow maritime choke points such as the Strait of Hormuz or the Suez Canal. A choke point is a narrow passage where large volumes of trade must pass. Even the possibility of disruption in these locations can move markets dramatically. Insurance costs for tankers rise. Shipping routes adjust. Traders begin pricing in uncertainty. And once again, prices climb. But rising oil prices don't only affect energy producers and traders. They influence central banks. Central banks manage monetary policy, which includes controlling inflation and stabilizing economic growth. When energy prices rise sharply, inflation often follows. Transportation costs increase. Manufacturing becomes more expensive. Food production costs rise. As inflation accelerates, central banks may raise interest rates. Interest rates are the cost of borrowing money. Higher rates are used to slow economic activity and prevent inflation from spiraling out of control. But higher borrowing costs also affect mortgages, business investment, and government debt payments. In other words, an oil price surge can eventually influence the cost of buying a home or financing a business. That is how energy markets connect to everyday life. But there is another layer beneath all of this: energy dependency. Many countries import large volumes of oil because their domestic production cannot meet demand. Europe, Japan, and much of South Asia rely heavily on imported energy. When prices surge, their economies face rising import bills. That weakens trade balances and can pressure national currencies. A weaker currency makes imports even more expensive, reinforcing the inflation cycle. Meanwhile, exporters experience the opposite effect. Their currencies often strengthen as oil revenues increase. This shift in currency flows can reshape financial markets. Investors may move capital toward energy-producing economies or commodities linked to energy supply. Gold markets sometimes react as well. Gold is often viewed as a hedge against inflation and geopolitical uncertainty. When oil-driven inflation rises or geopolitical risk increases, investors frequently allocate more capital into gold. The ripple effects spread even further. Higher fuel costs affect global shipping and logistics. Shipping companies face increased bunker fuel expenses. Airlines pay more for jet fuel. Trucking companies see operating costs climb. Those expenses eventually filter into the price of goods transported around the world. This is how a geopolitical event near an oil pipeline or shipping route can slowly translate into higher prices on supermarket shelves. Yet through all of this complexity, one pattern consistently emerges. Oil price surges concentrate financial power. On its producers gain revenue. Energy companies gain profit. Commodity traders gain opportunity. Financial investors gain exposure to rising commodity markets. But energy importing economies absorb much of the cost. Households pay higher fuel prices. Businesses face higher operating expenses. Governments confront rising inflation pressures. The effects spread unevenly across the global system, and that imbalance can shape political decisions. Governments may release strategic petroleum reserves to increase supply. Strategic reserves are emergency stockpiles of oil maintained to stabilize markets during disruptions. Countries may also accelerate investment in renewable energy to reduce dependence on imported oil. Energy transitions often accelerate during periods of high prices. History shows that moments of crisis can reshape long-term energy strategy. But transitions take time, and until alternative systems scale globally, oil remains deeply embedded in the architecture of modern economies, which means price surges will continue to redistribute wealth and influence, not just between companies and consumers, but between nations, between financial markets, and between competing geopolitical interests. Because oil sits at the intersection of energy, finance, and power. When its price moves, those systems move with it. Understanding that connection helps explain why oil shocks echo far beyond energy markets. They reshape currencies, they influence inflation, they alter investment flows and political calculations, and sometimes they quietly shift the balance of power in the global economy. If this helped you see the bigger picture, take a moment to like the video, share your thoughts in the comments, and subscribe to Rise and Ruin, Power of Wealth for more documentaries on oil, power, and the forces shaping global finance. Because in the modern world, the most important geopolitical battles are often fought not just with armies, but through the invisible currents of energy, money, and markets.